Joel Greenblatt's Gotham Capital managed to have annualized returns of over 40% for 2 decades. In this video, we will be looking at what Joel Greenblatt looks for when he invests in a business. He is also a known writer. He wrote the little book that beats the market, and you can be a stock market genius even if you are not too smart. I have read them both, and I can't recommend them enough. I don't follow the magic formula investing method, but it opens your brain when it comes to the world of value investing. Also, Greenblatt has a lot of humor in his books, so it makes those even better reads. He reminds me of Peter Lynch in many ways. Greenblatt had a talk at Google, and we will now cover a clip from his talk. If you want to watch the whole video, I will leave a link in the description.
Stocks are not pieces of paper that bounce up and down and you put complicated ratios on, like Sharpe ratios or Sortino ratios. Stocks are ownership shares of businesses that you are valuing, and if so inclined, try to buy at a discount.
That right there is the first thing investors need to understand. You are not just buying a piece of paper. You are becoming a small owner of a business. Buffett says that if you are not willing to hold a stock for 10 years, don't even think about owning it for 10 minutes. Value investing is a whole other business than trading.
So if you believe what Ben Graham said, that this horizontal line is fair value, and this wavy line around that horizontal line are stock prices, and you have a disciplined process to buy perhaps more than your fair share when they're below the line, and if so inclined, sell or short more than your fair share when they're above the line, the market is throwing us pitches all of the time.
There is one thing I don't agree with here, and that is I never short a stock. Simply because the markets can stay irrational far longer than you can stay solvent. And why would you go for a deal where your max return is a double and your worst return is bankruptcy?
The reason people don't outperform the market, there are behavioral problems, there are agency problems, but it's not because we're not getting those opportunities. I will show you briefly. Let me tell you how we value stocks. It's not very tough, and I think most of you will understand it. And I think the best example that seems to resonate with most people is thinking about buying a house. And to keep the numbers simple, let's say that someone is asking $1 million for the house. They want to sell, and your job is to figure out whether that's a good deal or not. So there's certain questions you would ask. One of the first questions I'd ask is, well, how much rent could I get for that thing? Okay? So in other words, if I rented out that $1 million house, how much rent would I collect? If I were going to collect $70,000, $80,000, $90,000 a year, 7, 8, 9% yield on that house, that's one way I might go about valuing it. And what's the next question you would ask? I'm pretty sure I know what it would be. What are the other houses on the block going for, in the block next door, in the town next door? How does this compare? How relatively cheap is this relative to all my current choices? So that's what we do. We look at how relatively cheap is this business relative to other similar businesses, relative to a whole universe of choices that I have. We do that.
The house is a great example, and all of these questions are on point. Definitely checklist worthy questions.
We also go back in history, look at how this company or this house has traditionally been valued versus other ones in the neighborhood or versus other communities, and how is it being valued now. So measures of absolute and relative value. Absolutely cheap, on a rental basis, absolutely cheap or relatively cheap on all different kinds of measures that make sense to you. Now, you wouldn't use any of these measures all by themselves. If you just use relative cheapness, if some of you remember the internet bubble and you bought the cheapest internet stock, that wasn't cheap. It was just cheap relative to all the other crazy priced stocks at the time.
This is a great example and also works both ways. Greenblatt here talks about the time of the internet bubble where every internet company was very expensive. But there are also times like post-2008 where every company seems relatively cheap. I believe that in a situation like that, instead of buying AT&T at one-time earnings, it would be much better time to buy Costco at single-digit earnings. Of course, these are just examples that I made up to make my point. I don't expect either of those companies to go down as low.
But we use our measures of absolute and relative values, checks and balances against each other to try to zero in on fair value. So when you do this, just want to show you a simple chart. This is actually a study we did of our valuation methodology, very, very similar to the way I just said we value a house. This is how we looked at the 2,000 largest companies in the US over a 20-year period. This was 1992 to 2012. And we ranked them on a daily basis from 1 to 2,000 based on their discount to our assessment of value using these metrics. The x-axis here, you probably can't see it, is just the valuation percentile. All this means is if you were in the bottom left-hand corner and you were in the first percentile, you're the 20 companies at any particular time out of those 2,000 that measured cheapest according to our measures of absolute and relative value. Go to the 99th percentile, you would be the 20 companies that measure most expensive out of those 2,000. The y-axis is the year forward return on average during those 20 years. What this chart simply says is, on average, stocks that fell in our first percentile, the cheapest 20, averaged a one-year forward return during those 20 years of 38%. Stocks that ranked in our second percentile averaged a one-year forward return of about 37%. And then we drop down to this best fit line, which we always say we don't mind missing when we're making extra money. And then as we measure something more expensive, the year forward return drops. And if you were sitting in my class at Columbia, and I said, hey, does anyone see a long-short strategy you might pursue if you could predict ahead of time which stocks would do best, second best, third best in order? And you did not say, I guess I'd buy these guys up here in the upper left-hand corner and short these guys in the bottom right-hand corner. If you didn't say that, I'd probably throw you out of class because it's very straightforward. That's what you should do. And by the way, that's what we do.
Now, this chart is great. The best companies to buy according to his valuation metrics are the best performers. You can see them on the left side of the chart, and the worst companies according to his metrics return the lowest.
The important thing to understand is that stocks are ownership shares of businesses, okay? Now, by the way, that beautiful chart I showed you with the 90% fit, you know, why doesn't everyone do this? Well, unfortunately, it doesn't look like that when you're living through that. That's an average over 20 years. If I showed you a snippet of 3 or 4 years, the fit would be nice. It might be 0.55, 0.6, something like that. But it's not going to be very cooperative, right? If what we did worked every day and every month and every year, everyone would do it, it would stop working. But it doesn't, unfortunately.
Now, when we talk about Joel Greenblatt, the first thing that comes to mind is the magic formula. And the magic formula basically has two variables: the earnings yield and the return on capital. Earnings yield is basically how much the company is making divided by what you are paying for it. And the return on invested capital is net operating profit after tax divided by invested capital. Basically, to find out if they are making profitable investments. For both the earnings yield and the return on capital, the higher, the better. So if a company has a 20% earnings yield, meaning a PE of 5, and a high return on capital, let's say 25%, that company would probably get a great score on the magic formula. The best thing I love about this is it shows how easy it is to eliminate bad companies when you are looking for new ideas. And it also shows the strengths and the weaknesses of a company you might like. For example, if a company you are planning to invest in has a high earnings yield, meaning things are going good right now, but a low return on investment, that might warn you about the future of that business, and you might want to dig deeper and try to figure out that reason the return on investment is low. So the magic formula overall just makes the investment process much simpler in my opinion. So that was it for today. If you like this video, please leave a like and subscribe. And if you have any questions or thoughts, you can let me know in the comment section. Take care. Bye.